Most traders think they lose money because of bad luck, but the real reason is almost always bad decisions made in the heat of the moment. Today we are going to fix that because the frameworks professional traders use to make decisions are not secret, they are just rarely explained in plain language. Let's start with the uncomfortable truth. When you enter a trade because something feels right, because a chart looks familiar, because someone in a Telegram group is excited, you're not trading, you're guessing. Guessing dressed up in charts and terminology is still guessing. The difference between a trader who survives long enough to get good and one who blows their account in 6 months usually comes down to one thing. Do they have a framework for making decisions, or are they making it up as they go? The frameworks we are covering today are not new. They come from poker theory, behavioral economics, military strategy, and statistical thinking. But applied to crypto markets, they become some of the most powerful tools you can have. The first framework is expected value, and it is the foundation everything else builds on. Expected value, or EV, is simply the average outcome of a decision if you made it 100 times. The formula is straightforward. You multiply each possible outcome by the probability of that outcome happening, then add them all together. Positive EV means the decision favors you over time. Negative EV means it drains you over time, no matter how good it feels in any single moment. Here is a concrete crypto example. Say you are looking at a trade where you think there is a 60% chance you make $200 and a 40% chance you lose $100. The EV is 60% of 200, which is $120, plus 40% of negative 100, which is negative $40. Combined, that is positive $80. That is a bet worth taking, not because you win every time, but because over a large number of similar setups, you come out ahead. Now flip it. If you have a 60% chance of losing 200 and a 40% chance of gaining 100, your EV is negative $80. That is a trade to avoid even if the 40% scenario happens to you first and you walk away feeling like a genius. The reason most traders never think this way is that they evaluate trades by individual outcomes instead of by the quality of the decision. You can make a terrible decision and still profit. You can make a perfect decision and still lose. Judging your process by the result of any single trade is one of the most dangerous habits in this space. EV forces you to zoom out and ask, if I took this exact setup 50 times with the same conditions, would I be up or down? The second framework flows directly from expected value, asymmetric risk and reward. The idea is simple. You want situations where your potential upside is significantly larger than your potential downside. Not equal, not slightly better, significantly better. Traders often talk about risk-reward ratios, and a common target is 1 to 3, meaning you risk 1 unit to potentially gain 3. But here's what makes asymmetry so powerful in crypto specifically. Crypto markets are volatile. They move fast and they move hard in both directions. That volatility is actually an advantage if you have the right setup. Suppose you enter a trade with a clear stop loss at 5% below your entry and your target is 15% above. Even if you are only right 4 times out of 10, you still come out ahead. 4 wins at 15% each gives you 60% in gains. 6 losses at 5% each costs you 30%. Net positive 30% on a strategy that loses more often than it wins. Most people emotionally cannot hold a strategy that loses 6 out of 10 times. They abandon it, they second-guess it, they start moving stop losses to avoid taking the loss. But a disciplined trader running an asymmetric setup does not need to be right most of the time. They just need to not sabotage their edge when it is working. The market does not care how you feel. It rewards asymmetry and punishes people who let emotion override their math. Third, base rates. This is a concept borrowed from statistics, and it is criminally underused in trading. A base rate is simply the historical frequency with which something happens. Before you place a trade, the question you want to ask is not just does this look good right now, but how often do setups like this actually deliver the outcome I expect? Imagine you see a technical pattern, say a bull flag forming on a 4-hour Bitcoin chart after a strong move up. You feel confident. But if you actually backtested bull flags in a bear market environment on that time frame, you might find the pattern resolves bullishly only 42% of the time in that specific context. That base rate matters enormously. It changes your position size. It changes whether you take the trade at all, and it prevents you from overweighting the pattern you can see in favor of the statistical reality you cannot feel. The mistake traders make is substituting how convincing a setup looks for how often similar setups actually work. This is what behavioral economists call the representativeness heuristic. The chart looks like the setups that made you money before, so your brain treats it as equivalent. But the chart looking convincing and the trade having a high base rate success are completely different things. Knowing the base rate anchors you to what is actually likely rather than what feels likely. Fourth, second-order thinking. First-order thinking asks what happens next. Second-order thinking asks what happens after what happens next. In crypto, most retail traders operate at the first-order level. Bitcoin drops 10%. First-order thinkers panic sell. Bitcoin pumps 20% on good news. First-order thinkers buy the top because the news is obviously good. Second-order thinking asks the follow-up question. When good news about crypto regulation drops and everyone rushes in, the second-order question is, who is already positioned for this? The answer is usually the large players who had early information or conviction, which means when the news hits publicly and retail rushes in, those early holders are now distributing into the demand you're creating. The first-order move feels bullish. The second-order reality might be that you are the exit liquidity. A practical application. Ethereum completes a major network upgrade. First-order thought, this is bullish buy. Second-order thought, this upgrade has been anticipated for months. The speculative premium was likely priced in during the anticipation phase. Historically, buy the rumor sell the news is a real phenomenon because sophisticated market participants position early and unwind into the event. Second-order thinking does not mean being contrarian for its own sake. It means asking who is on the other side of your trade and why they might be willing to take it. Fifth, and this is the one most people skip because it feels unnecessary when you are confident, pre-commitment. Pre-commitment means deciding in advance what you will do when certain conditions are met, before you are in the emotional state that those conditions create. Imagine you enter a trade. It goes against you immediately. You are now 5% down. At this point, your brain is in loss mode. Research on loss aversion consistently shows that the pain of losing is roughly twice as powerful as the pleasure of equivalent gains. So when you're sitting there watching a trade go red, the decision to hold or cut is not being made by the calm, rational person who read the chart this morning. It is being made by someone in mild psychological pain who desperately wants to avoid locking in that loss. That person makes terrible decisions. Pre-commitment solves this by removing the decision from that emotional moment. You decide your stop loss before you enter. You write it down if you have to. You set it in the platform. And you commit to the rule that the stop is not moved down. Not because rigidity is always right, but because your pre-trade self had access to clear thinking your mid-trade self will not have. The same logic applies to taking profits. Decide your target before you enter. If Bitcoin hits your target, you take the profit. You do not let greed convince you that it could go another 20%. You stick to the decision your calm self already made. Pre-commitment also applies at a higher level, what you might call trading rules. Rules like never risking more than 2% of your account on a single trade. Rules like never trading in the hour before a major macro announcement. Rules like not opening a position after a string of losses because your judgment is compromised. These rules feel unnecessary when things are going well and feel impossible to follow when things are going badly. That is exactly why they need to be pre-committed rather than re-evaluated in the moment. Now, here is what ties all 5 of these frameworks together. Expected value, asymmetric risk-reward, base rates, second-order thinking, pre-commitment. They are all, at their core, tools for making the quality of your decision independent from your emotional state in the moment. Professional traders are not less emotional than retail traders. They have the same dopamine hits on wins, the same dread on losses. The difference is they have built structures that prevent emotion from overriding process. Think about poker as an analogy. A professional poker player is not trying to feel confident about every hand they play. They are executing a strategy with a positive expected value over thousands of hands. Some sessions they lose. The session result does not tell them whether they played well. The quality of their decisions tells them that. Crypto trading, at a serious level, is closer to poker than it is to lottery tickets. The market gives you information, you make decisions, your edge plays out over a large enough sample. But only if you have an edge, and only if you execute it consistently. The hardest part of all of this is that markets are designed to feel urgent. Every price movement looks like a signal. Every dip feels like an opportunity or a warning. Every run-up feels like a trend you are missing. The volume of noise is overwhelming, and your brain is wired to find patterns and assign meaning to things that are sometimes just random. The frameworks we covered today are not magic filters that tell you what will happen. They are frameworks for asking better questions before you act. Better questions lead to better decisions. Better decisions, over time, lead to better outcomes. Discipline is not a personality trait some people are born with. It is a system. It is pre-written rules followed by a person who had the foresight to make them before the pressure came. Emotion is not your enemy either. Emotion is information, but it should not be your decision maker. The traders who last, the ones who are still at this in 5 years, are the ones who build their process when they are calm and then protect that process when the market tries to break it. If you want to see what it looks like when these frameworks are systematized rather than left to individual willpower, Vishmaster has built automated trading infrastructure around exactly this kind of structured, rules-based decision-making. No emotion in the loop, no discretionary overrides in the heat of the moment. You can explore that at vishmaster.live. Decision-making frameworks are where this starts. Consistent execution is where it pays off.